This video is on grantor retained annuity trusts. For anybody who's accumulated significant assets throughout their lifetime in excess of the federal lifetime gift exclusion amount, when this is somewhat common in business owners, they're probably going to have a rude awakening when they go to give their assets to their beneficiaries, either while they're alive or through their estate after they die, because the IRS is really going to want to get in their pockets. The Grantor Retained Annuity Trust is a great vehicle for gifting assets at today's values before they appreciate. So here's how a Grantor Retained Annuity Trust works. First, you set up an irrevocable trust and gift the assets to that trust at today's values. So that could be stocks, bonds, real estate, your stake in your business, whatever it might be. The trust is drawn up with a specific term, let's say hypothetically 10 years. Over those 10 years, it's drawn up with the agreement that you're going to collect income from the assets in the trust over that term period. So for 10 years, you're going to collect income from the assets in the trust. When the 10 years are up, the assets are forwarded on to your beneficiaries, which you specify. Now, remember that you have this lifetime gift exclusion amount. This is the amount that you're able to give to whomever you want throughout your whole lifetime, free of paying any gift tax. The amount that you contribute to the trust at first will work against your lifetime gift exclusion. The amount is the value of the assets you put into the trust less the present value of the future income over that trust term. So if you gift assets of, say, $2 million to an irrevocable trust, but you agree to collect 10 years worth of $50,000 annual income, whatever the present value of those is going to work to reduce that $2 million gift. And the net amount will count against your lifetime gift exclusion. Now, the interest rate which you apply to that present value formula when you figure out what this value of future income, future tax flows that you collect from the trust is, that's very important, because if interest rates are high, that means that the present value of this cash flow stream is going to be lower, and it's going to work less against the amount that you're contributing to the trust now, and therefore work more against your lifetime gift exclusion. But if, on the other hand, interest rates are low, that means that the present value of the cash flow of the income you collect from the trust is higher, and that higher amount will work to reduce your present gift further and therefore count less against your lifetime gift exclusion. Now, this interest rate is published in the Internal Revenue Code section 7520. Currently, interest rates are pretty low in our society, so it's a good time to use Grantor Retained Annuity Trust, but when interest rates are higher, you don't get quite the same benefit. Okay, last point about Grantor Retained Annuity Trust is they're not for everybody. They do have a few drawbacks. If you die during the term of the trust, a portion of the assets in the trust will revert back to your estate. And that means that they'll work against your lifetime gift exclusion and could be subject to federal and perhaps state estate taxes too, and that's not ideal. So long story short, Grantor Retained Annuity Trust can be a great way to reduce wealth transfer taxes, especially for business owners, but they're not for everybody. They're a little bit complicated, and they need to be coordinated, like everything, with your overall financial and estate planning strategy. If you haven't done so already, be sure to check out our short video series on 3 easy ways business owners can reduce taxes. Just click this link to watch.